Welcome to AI Finance Daily, the show that makes AI economics make sense. Most people are getting this wrong. Today, we fix that. The subject: what happens to global markets if Taiwan is blockaded? The AI supply chain scenario. Imagine a blockade of Taiwan. Sounds extreme, but let's break down how a situation like this can lead to a 40% drawdown in global markets. Taiwan is not just a geopolitical hotspot. It's the world's leading semiconductor manufacturer, responsible for roughly 60% of global chip supplies. This specific concentration creates a vulnerability in the supply chain. First, visualize this: an almost instantaneous shortage of advanced semiconductors. In a matter of weeks, companies dependent on these chips for everything from smartphones to vehicles face production halts. As these sectors freeze, losses will cascade downstream. Investors will react swiftly, with panic selling driving markets down. Historical context. Remember the 2020 supply chain disruptions during the pandemic? The S&P 500 dropped about 34% in just weeks. The 2020 crisis was temporary. A blockade could lead to a structural crisis with lasting effects. Now, let's talk about the bull case. Why do smart investors own stocks related to Taiwanese technology? The answer lies in the perceived resilience and growth potential, despite geopolitical risks. Companies like NVIDIA and AMD thrive because of the insatiable demand for chips, a trend analysts have predicted will only intensify. Investing in these firms may seem logical given their innovation and market positioning. However, this brings us to a critical question. How does one balance these opportunities against the severe risks? The reality is, the bull case runs parallel to significant geopolitical risks. A blockade could undermine the very foundations of these businesses, and in turn, your investments. What does this mean for your money? Here's the personal implication. If you're heavily weighted in tech stocks, the fallout could directly impact your portfolio. As a macro investor, understanding this risk is a necessity. One scenario is that during a blockade, panic could lead to indiscriminate selling, where investors flee to safer assets, like bonds or gold, further driving down equity prices. So, how do you navigate this risk without retreating entirely? One cautious approach is to diversify your exposure. Instead of placing large bets on specific companies overly exposed to Taiwan, consider spreading investments across sectors less reliant on semiconductors. Simultaneously, hold some cash or alternative investments that could offer safety during market turmoil. Another strategy is to invest in firms positioned to mitigate this risk. Companies with robust supply chains, or those working to accelerate domestic semiconductor manufacturing, present an interesting play. These firms might see appreciation as markets react to the necessity of building redundancy in supply chains. However, remember, while diversification and strategic positioning offer some protection, they aren't foolproof. Current market sentiment can change rapidly based on updates about the geopolitical climate. Staying informed is essential. Analysts suggest monitoring developments around Taiwan closely, as scenarios can evolve unexpectedly. In conclusion, the stakes are high. A blockade of Taiwan could lead to a significant drawdown in global markets, reminiscent of past crises, but potentially with deep, lasting implications. Recognizing this, safeguarding your investments with thoughtful diversification and strategic positions becomes invaluable. This is a risk scenario, not a certainty. The figures discussed here are drawn from publicly available data. Always verify before making any financial decisions. This is educational content, not financial advice. This has been AI Finance Daily. Stay sharp. And if you want to keep thinking clearly about AI and your finances, follow the channel. We publish regularly, and every episode is built to give you an edge.